Hello, Uncle Jim here. Today I want to share with you one of my favorite option strategies, and that's the options wheel. I want to go into some detail on why it works out so well for me, and at the end of the video, I'm actually going to share some trades that I did this week. This is one of my most profitable weeks, so stay tuned. I think you're really going to enjoy what I have for you today. Okay, I've got quite a bit to cover, so let's go ahead and get started. So, why am I talking about the option wheel now? Part of the reason is we're still nowhere near the highs, even though we've had a really good beginning of 2023. The graph above me is actually a recent graph. It includes actually today too, with the big move upwards today. So you can see we're definitely not out of bear market territory, but we're kind of in a bear bounce is what I like to call it, or maybe a short-term bull market. But I don't know. I firmly don't believe we're really in a bull market till we've reached new highs. And I don't think we're going to reach new highs this year. I think maybe in 2024. I could be completely wrong. I don't think anyone predicted that we'd have the month that we had back in January and the start to February. I think the Fed, with its announcement and only raising a quarter point, really made a big difference. Plus, they kind of, I don't know, they were less hawkish. They talked about future increases, but I think we may have one more quarter increase and we may be done. Now, I don't know that they're going to decrease them quickly. I think they're going to take their time and probably decrease them slowly over the next 2 years. So, that being said, I do still think lots of bargains exist. A lot of the bounce we've had in the last month has been the Nasdaq and some of the big companies, and unfortunately, some of that comes about because of the announcements of layoffs, like Google's. I think they had 11 or 12,000 people, as well as Meta. Apple, I believe, even had those announcements, and I think they've had a bounce because of that, and they've had better earnings. I know Meta came out with earnings, I think yesterday, that were quite good. Apple's supposed to come out today. I don't know what they're going to look like, but the rest of the market, like Coca-Cola, I think is down today, and a lot of the um, dividend value aristocrats are actually down. They haven't been moving much. So there are some really good values out there that you can find, and that's kind of why I feel like the option wheel is a great strategy to use. Now, what is the options wheel? You may be curious as to what it is and how it works. Well, to keep things simple, it's really just four things. The first is you sell a put and you pick a price for that stock that you want to own it at, and then if it gets assigned, then you own it, and at that point you can actually sell a call as well as pick up dividends as you own it. And then if it then gets called away from you and you have a bunch of cash come back, then you can repeat the process, and it's almost like a wheel. You go through this circular process: sell a put, let it get assigned; sell a call, let it get assigned; sell a put, let it get assigned. And along that trajectory, you're also picking up dividends and you're owning a stock. And a lot of the stocks that have been assigned to me, I'll share with you one of the ones that has worked really well for me, and that's BEN, or Franklin Resources. And I've got a spreadsheet at the very end where I'll talk about that, and you can actually see the process in action and how it worked. But I plan to own these stocks the rest of my life and pass them on to my son. I rarely sell, any of these really good value aristocrat companies that pay good dividends and have, not just pay good dividends, but are increasing their dividends every year. So I'm always looking at, both angles. I want to earn the premium, but I also want to earn the dividends. So, and then I did want to mention, I do it a little bit different than a lot of other people. I will start with a cash secured put. Now with BEN, which is, I think it's in the low 30s currently, but it was in the mid 20s or low 20s. It's not that expensive, so you can definitely do it with a cash secured put. But some of the other stocks that are really expensive, it's a lot harder to actually do a cash secured put. And again, a cash secured put is just you have the cash to be able to own the shares that you're selling the put with. So I typically, what I do is I look at a cash secured put that I like, where I like the strike, and I typically will go to, look at a spread or look at the opportunity if I go $10 out to see if I could buy a put that's $10 out that literally turns it into a vertical put credit spread, which simply means, so let me give you an example to make it a little bit easier. So say it's a $25 stock and you are fine with owning it at $20. Well, you may sell the put at $20, the $20 strike price, and then if you go $10 out, you might look at a $10 put that you could purchase, and that gives you downside protection. So say that stock dropped below that $20 and kept going down, you could always put it to someone else by buying the put at $10. So it protects you on the downside, and you don't need to use as much cash or margin in order to do that. And I typically will look to see if I can purchase one at a fair value. I typically try to get around $100 for like a $10 spread, and if I can't get that, and that's for one contract, and if I can't get that, then I typically will look for a different security to use, or I'll look. I try not to go farther out and make the spread wider, but I typically will look and see, well, sometimes I can find a less expensive put, a little closer to the short, meaning so instead of buying a $10 put, I might buy 11 or $12 put, depending on, the price, or if the 11 or $12 put is a little less expensive, I will look at buying that. So in a sense, I'll typically do that with all my trades. So probably 70% are probably vertical put credit spreads, whereas the other 30% are cash secured puts. And that's just how I like to do it. It allows me to do more trades, and to use less margin in my accounts. Next, one thing I do want to mention, I've taken less risk with puts because I've done a smaller delta, but sometimes I question that. Maybe I should do a higher delta, especially with stocks that I currently own or want to own, mainly because I'll end up selling put after put after put and never owning the stock. And I've had that happen a few times. An example will be Best Buy, BBY. I've sold probably a half dozen cash secured puts or vertical put credit spreads on it, and I do want to own it because it's a really good company, but I'm not able to pick it up, so maybe I should take more risk for that because I really do want to own it. So I do think there's a little bit of opportunity cost that I've run across, mainly because I was a little fearful. I did have a few things assigned, which in reality were the wheel, but they didn't work out real well. One is Big Lots. It's tanked, and it has come back a little bit, but it's still like a 40 or 50% down from when it was assigned to me. So I have missed a little bit of an opportunity. I'd be curious to what you guys think. Add a comment below if you think I should use a higher delta for puts going forward. There's a little bit of me that thinks, well, now that we're kind of not really in true not bear, but bull territory, we are kind of in a bounce or a short-term bull market, that maybe I will go back to a 20 delta for puts as well as calls. And actually, if we go into a full-blown bull market, I might switch it. I might use the 20 delta for puts and a 15 delta for calls. I've had some people leave me comments that they only look at 10 deltas for calls, but I've always done 20 delta, and I've only had a few get assigned to me or get called away from me with a 20 delta. You're typically able to roll up. The exception again was Microsoft. If you go back and watch that video, it didn't work out too well for me. So that was one of my biggest losses, and that's why I no longer do call vertical credit spreads, which are the opposite of put vertical credit spreads. So that's why I no longer do those. I only do covered calls, and I decided not to do the call credit spread strategy anymore. So again, I just wanted to share that. Sometimes I wonder if I've missed some opportunities. So let's jump into the next part of this video, which there'll be two more parts. The first part will be just an example of a doing the wheel strategy on Franklin Resources. And the last one I'll share with you is my trades that I did this week. This week has been quite profitable for me, and I'm sure it's probably been profitable for a lot of people with the market going up so much. So, and before we jump into that, as always, please subscribe, hit that like button. I'm still a small channel trying to grow. And if you're curious to learn more about my memberships, take a look below. I'll have links. There's two membership levels, and one or both of them I actually share all my trades, and I have a worksheet I put out every Monday morning that I have some of my favorites that I'm looking at, and I also share what I'm planning for the week and what I'm doing. And for my more expensive, I do some one-on-one coaching. I've got coaching calls every week. So I encourage you to take a look. It may be something worth your while. So that being said, let's jump into the next part of the video. Okay, let's jump into the first worksheet I want to cover in this video. And this is just my example of Franklin Resources using the wheel strategy. And if we go back to and this spreadsheet I actually just exported directly from Schwab. When you go to the history page, you can sort and filter by specific securities, and that's all I did. I just filtered by BEN or Franklin Resources, where it includes options. Then I exported it and I cleaned up the worksheet a little bit, and that's what I have here. So if we go back, you can see I first sold an option, a put option, at $27.50, and I bought a put at $20. So again, I turned it into a vertical put credit spread versus just a cash secured put, because I was able to buy this put at $20. So it was a $7 spread. And to me, I was able to almost reach what I typically try to do, which is $100 per contract. And then I did it again. Here you can see I sold to close, buy to close, buy to open, sell to open. So I rolled it, and instead of letting it actually get assigned, I went ahead and rolled it, and I picked up more premium. I believe it was close to, I don't know, about $80, $90, I guess, in additional premium. And then what happened is in October, here you can see this is 1024, and that was pretty close to the bottom of the market. Franklin Resources really went low, and it got deep in the money. And next thing I know, it actually got assigned to me, and the put that I had purchased expired because it wasn't worth anything at that time. And the shares were assigned to me, so they were assigned to me again on 1024. Here you can see them being purchased in my account for 200 shares, and $5,500 came out of my account. So at that point, I had done pretty much half the wheel. So next thing I did was I went and actually sold a call at 32.50, which now currently is in the money again with the market going up so much. So it could be called away from me. I'm probably going to roll it higher and pick up more premium. My goal typically with rolling is, again, to improve your strike price and to always bring in premium. So that's probably what I'm going to do again. But during the process, I've also gotten a dividend of $60, which isn't bad. And then here on February 2nd, which is today, it went up to 34.25, which is 68.50. So even currently, it's got a really nice return of over 31%, or right at 31%, which is $1,700. So, it's turned out to be very profitable, even though it was fairly deep in the money. I think at some point it was close to, well, you can see it was 818, and I spent 741 to close. So it was very deep in the money for a $30 stock. But again, I like Franklin Resources. It's a company that I like to own. They pay good dividends. They're growing their dividends, and they have good financials. So it's a really good company. If you don't currently have Franklin Resources, it's something you might want to look at. So this is kind of the wheel in action. This is how it works. It's not something that happens really quickly. It does take time. You need to kind of work it So it's not something you can do really quickly to pick up money really fast. It's kind of slow and steady. So with that being said, let's jump into the next part of the video, and I'll share with you some of my trades this week. Okay, here's my planning worksheet for this week. This is what I released to my memberships on Monday morning. And this planning worksheet's a little bit different than most because here at the top you can see, since it bridged two different months, I'm showing how much I've done since this finished January. I did $1 short of $4,000, which $4,000 my goal, on how much premium I want to earn each month. And then with just the trades I've done so far in February, which is just today and yesterday, I've done over $638. I'm almost 640. So you typically don't see both two different months in the same planning worksheet, but since it bridged or went over two different months, that's why I have that here. And then at the top, I have my top picks. These are the stocks that I'm recommending for the week. I talk about the company and what type of option I'm suggesting. So this is a vertical put credit spread. This is Truist, which I bank with Truist. I really like Truist. It used to be SunTrust, and they merged with BB&T, and I believe I really like the new merged bank. I've been really happy with the service they provide. So I talk about the current price, the short strike, 42.50, the outer strike, expiration, what delta I'm looking at, and what premium I'm looking at, and then I give a little bit of a reason. And I typically do 4 stocks each week, and these are all companies I've traded in the past. Another one is Apple. I haven't done anything with Apple this week yet. I'm waiting on the earnings today to see what's going on, but at their current price, I looked at 130 and 120, which I've done a lot of trades at 130 and 120, and none of them have actually been assigned. I've been able to get out of them fairly easy, either through closing or expiring. I again put the expiration date, I put the delta, and I picked a little bit of a lower delta with Apple. And then what kind of premium I'm thinking of. So the next one is BBNY, which is Best Buy, and I had mentioned Best Buy before. I do want to own it. I believe it's over 90, it may be 90, 95 currently. So again, all of these I'm looking at vertical put credit spreads, 85.75, with the outer strike for Best Buy would be 65, expiring March 17th, almost a 17 delta, and what kind of premium. And the premium is usually not completely right, mainly because I'm typically doing this on a Sunday afternoon to provide it to my memberships on Monday morning. But and then the next one is Polaris, and I really like Polaris. I've been told by friends, don't ever get a motorcycle. I end up killing myself because I have such bad balance. But I really like the idea of maybe getting one of their all terrain, like the Slingshot or something along those lines. It looks like it would be fun and something I could do. I probably wouldn't kill myself. So, but Polaris has worked out really well. I've sold a number of vertical put credit spreads with them. Currently, they're at 170 and a 95.85 for the two strikes, for the 95 for the short, 85 for the one longer out, March 17th. This would be a 19 delta, and it pays a lot of good premium. Typically, it's it's fairly volatile, and it typically has good premium. And four of these companies are really good companies. Best Buy's got really good financials and pays a good dividend. So does Polaris. So next, I was going to jump down. I don't want to go through all of these because I don't want this video to be really, really long. The ones in green are the ones that I've done. So, and then the initiation date was the original initiation date. For the new ones, you can see 2122. But I've done 5 trades. Oops, let's cancel that. So I've done 5 trades. eBay, I rolled. It was a cover call. I rolled it out. I believe I did that one today. I rolled it up and out from 47.50 to 49, and it's currently at 51.39. So it's still in the money, but I did pick up $219 in premium. And this is another wheel type scenario. And currently, at one time, eBay was really kind of a little bit of a loss for me. Now I believe I've got like a 4 or 5% profit with it. And then for this trade, using the premium, the required margin, and then what the yearly return would be. Again, for cover calls, I'm more looking for doubling the dividend, not so much making outrageous returns. And again, when I roll a cover call, I always try to roll it to a higher strike and pick up premium. So I'm always trying to improve that position. But I don't know. I believe that the market is going to probably come back down. Now, I don't know if it's going to be late. It could be later this week, or I mean, tomorrow, I guess, or it could be next week, or it could be sometime in March or April. But I do think we will kind of come back to slightly lower prices. I don't think we've gone into a full-blown bull market, but I tell you, the market keeps surprising me. So who knows? Maybe we are in a full-blown bull market, but I don't think so. This is Polaris. I closed it. I think I spent $15 to close the existing position. And I did the same thing with Williams Sonoma. These are, again, two that I really like. And I was able to close both of those, I think, for a total of $20 or $30 with the fact that they've gotten, they went up so high in price because Williams Sonoma, the short strike was 95. I think both of these went well into the hundreds. So those I closed. And then my new positions were XLE, which is a gasoline and power ETF. I'm not describing that correctly, but it's one of my favorite ETFs, and I opened a new position with them, and I opened it at 80 with the farther output at 70, expiring March 30th. The current price is 89, so it's still fairly far out of the money. And with that, I brought in $185 and earned a 74% return. This is the actual required funds that are needed, which is just literally, since it's a $10 spread in two contracts, it's literally just 2,000 minus the 185. And then this is based on the number of days related to the year. So this is yearly return. So this is probably my best trade, was XLE, and it was it's pretty near a 75% return. Next was a roll, IGH. This is our covered call. It was originally 259.87, expiring the 17th of February. I rolled it to 262.90, so not that much higher, but I believe it was actually, I rolled it, that's what the current price was. I rolled it to 275, expiring August 18th, and I picked up $358 in premium. Now, it's an expensive ETF, and it typically is fairly volatile. It has quite a bit of premium, so that was probably the biggest cash premium I've had this week. And you can see that's the total outlay, and it, just in the sense of 262 times 100, and it's only like a 2.5% yearly return based on the dividend. So it's a little, not based on the dividend, it's a little bit better than the dividend it pays. So it's, did pretty well with that, but I don't think it'll ever get to 275. Very, very unlikely. I think its all-time high is like 280. So, and if it does get anywhere near that, I'm pretty confident I can roll it. Next, I did BBY, so another vertical put credit spread, two contracts, 75.65. So the short was 75, and then the put that I purchased was 65, expiring April 21st, and its current price is 86. So you can see it's pretty far outside the money. This was also like a 15. Actually, I think it was closer to a 19 delta. And then I brought in $231. Here again, it's just the difference, the 2,000 minus the 231, to help me calculate what the yearly return is, which is over 60%. So, not bad at all. And then finally ARKK, which was really unusual. When it went through the roof today, it was up $3 or $4 today. So I couldn't control myself. I had to go ahead and roll that and make some extra money there. So the strike, this one wasn't expiring till March 17th. So I really didn't need to roll it, but I wanted to because it was such an up day. ARK had been down so low. I really thought it was going to be a huge loss, but I believe now I only have like a 20% loss with it. So I rolled it. Current prices, when I originally did this, it was 33. Now I believe it's over 44. I think that's the current. No, that's what I rolled it. No, that's not what I rolled it to. That's the current price as of today, $44. So I had no idea or didn't think it would go up to 44 again. So nice. I might be able to get out of ARK with a profit, which would be really nice. So I rolled it to 48. So expiring June 16th at $48. And then that brought in $188. Now this is the value of the three contracts at 44.45, and that's where I got that number to come up with what the yearly return is. The 188 divided by this, and then set up related to how many days are left in the year and stuff. So that's how I came up with the 3.84, which is I don't think they pay much of a dividend at all. So that's definitely much higher than a dividend. And I'd be real happy at 48 if it gets called away from me. I think I've got like a 10% loss. I never would have thought I'd have only a 10% loss with ARK. So those are the trades that I made, and here overall you can see I've done $1,183 just this week, and the week's not even over. I'll probably do another trade tomorrow, so it could be a 12 to 1300 week. And here you can see it broken down by the two different months. So this was still January, which was Monday and Tuesday, and then between yesterday and today I've done 638. So it's worked out really well. So I hope you enjoyed this. If you have any questions about any of these securities, leave a comment below. I don't think I've forgotten anything. I may not have put much in here related to the deltas on these trades. Actually, or did I? I might have forgotten to put those in there, but most of the new trades were, again, closer to the 15 delta, but usually between 15 and 17 delta. So again, any comments, add them below. I try to answer all my comments. So hope you enjoyed this. Hope you have a wonderful day. Thanks for joining me.